With candlesticks, it's all about context. The pattern we're going to look at today is definitely no exception. This is a hammer. Now, a hammer is an interesting formation because it indicates a significant shift in investor sentiment. Let's just talk about what the pattern looks like itself. You have, first of all, your trading range for the day. So we're drawing a little candle here. We've got our low for the day and we have our high for the day right there. Now, the body of the candle is all concentrated right up here at the very top. What this looks like eventually is that almost no upper shadow up here and a lower shadow here that's at least 2 to 3 times larger than the body itself. So you're looking for something that shows the traders, bulls were in control, or bears were in control. They pushed the market way down, and then the bulls stepped in and pushed the market all the way back up after having lost control earlier in the session towards very close to either above or below the open for the day. So you get this very small body, long lower shadow. The hammer indicates that essentially you've had a shift in investor sentiment from very bearish at one point to very bullish by the time the session ends. Now, it's all, as I mentioned before, it's all about context, because if you just look for this kind of a formation arbitrarily, you'll find them, but you'll start to lose your trading edge if you ignore the context that they're in. So for example, if they're in, oftentimes you'll hear traders talk about hammers as hammering out a bottom. If you find a hammer in a situation where you're at in the middle of a significant downtrend, longer term downtrend, it's not typically something we look at as an indicator that suddenly the market's going to shift and start heading back up. Maybe something we want to be aware of, but not necessarily trade. Conversely, if you look for hammers in the middle of a nice uptrend where the market has reached a top and has started to correct, if you find it right there in the middle of this little correction, that's where we look for our opportunity, because when we see a hammer there, we start to expect some upside potential or a bounce back out of that correction. So here's a great example actually. The dollar CAD, and we're looking right now at a longer term chart. This is a longer term chart of the dollar CAD, and you can see there was a nice support level here and a longer term rise from the lows previously in the year before. So we've had this longer term uptrend where we've got an established former resistance now acting as support right there in about September, late September 2008. Well, if we zoom in on this chart and let's look at those candles that were appearing as it started to hit that support level, you'll notice there was a dramatic hammer here. So we get almost no body to the upside. We have almost no shadow up above the body, and we have a long lower shadow. This is exactly the kind of behavior we want to see. And subsequently, the market really took off to the upside. So it was information provided to us by the market that investor sentiment was beginning to shift. If we want to start looking for a trade opportunity, this is when we would start to look for that. Conversely, imagine that we were a much more speculative and aggressive trader taking a position to the downside, perhaps on that correction to the downside. This is a big warning that the previous trend and the hammer are telling us that the market is probably not going to go down any further. Our risk is very high. It's time to start controlling that risk and even exiting those short positions. So depending on what kind of a trader you are, it's a matter of context. Looking for a hammer in market conditions that look like this and a pattern that looks like that will give us a decent probability of finding a good opportunity to the upside, where not only do we have a good chance or a good edge that the trade will work out well, but we have the odds in our favor that we're going to get a nice risk to reward, meaning that we're going to make more than what we would potentially lose if the trade goes bad against us.